Well, welcome to another monthly edition of a Rogers Capital Market Commentary, where we attempt to be the antidote to water cooler wisdom. Well, man alive, huge February. We were up 5% last month. That puts us at about +7 for the year. Tremendous run, 4-month run, in fact. Strong earnings. And a Federal Reserve that's watching the economic slowdown, especially real disposable income, as to whether they're going to begin rate cuts later this spring or summer. And so a lot of optimism from Wall Streeters running things up again to record highs. I thought we'd take this month's video and address something I've heard quite a bit about here recently. Multiple clients mentioning Roth conversions. Now, I'm not a CPA, but I am, I don't give tax advice, but I am a CFP, and one of the 6 disciplines of a certified financial planner is income tax. A Roth conversion allows you to pay tax on your traditional IRA, converting it to a Roth IRA. You're basically paying that tax now instead of later. And by paying it now, your contributions, your earnings, of course, earnings being the real key, will be tax-free when you pull them out later. Another benefit is you can withdraw those contributions out and anytime, and provided you're meeting the 5-year rule, which we'll talk about here shortly, but without any RMD requirements at age 73. So several pros to this strategy, but several cons and several things you need to think about as well. This is not for everybody. So 5 things I'll walk you through. Number 1 is that this is a marketing strategy. Okay, so it doesn't mean it doesn't fit for you or we should dismiss it out of hand, but it does mean that you need to be wary. This is a marketing strategy. So for financial advisors who are trying to bring in new clients, they will go and buy a list from one of these marketing companies. Give me folks from age 60 to 80 with X amount of assets or income in these zip codes, and from publicly available information, they'll get a list of folks. And that's where your invitations for steak dinners and other things come from, okay? And this is a topic apparently here recently. There's actually been several waves of it. I can remember 2 other instances where it really became kind of a hot conversation item. Right? But the first thing to know is this is a marketing strategy. The goal is to get you to say, oh, well, why haven't I heard about this? And we should do this. And of course, they're trying to bring in new clients, new assets. Number 2, you're not getting out of paying taxes in this strategy, okay? We're shifting the tax to what hopefully would be a more advantageous timing for you as a client. Okay, so tax rates are likely going to be higher in the future. This country has a lot of bills to pay. We politicians, every time we turn around or writing checks, none of us are ever going to be able to pay. Taxes are likely to be higher. Okay, making some sense that we pay our tax now in favor of maybe better rates today versus in the future. But the fact that tax rates might be higher, I don't know. The question is, will you be in a higher tax bracket in the future? If you're in a lower tax bracket in retirement, does this make sense? If you're still employed right now, you're still working, you're at peak earnings years, then it might not be smart for you to do this just yet. You might want to wait a while. The money we're taking out of here and paying the tax on is going to go right to your 1040, to your income tax form. So that's number 2. Number 3, how are you going to pay the tax? So when we convert this money and taxes due, where's that money going to come from? Converting is paying the tax now instead of later in retirement. Let's go through a quick example. If you're going to take $100,000 out of an IRA and convert that to a Roth, well, $100,000 at the 24% tax bracket, that's $24,000 in tax that you have to pay now. Well, do you have $24,000 laying around doing nothing? If so, great. If not, well, what are we going to do? If we're going to take that from the IRA that we're converting, well, now you don't have $100,000 to go into this new Roth. You have $76,000 to go into this new Roth, handicapping it from the get-go. And the other little aha some folks find out about after the fact, if you're under 59 and a half, then that distribution is subject to the 10% penalty. And it's taxable. So, some things to consider there. The other thing is, what if the market's down? Now, the market's not really down now. We're setting all-time highs. The last couple of times, this strategy has been a big marketing, the rage in marketing. Markets were down. And one of the funny things to me was, okay, well, if we don't have the money and we're going to have to use assets out of this IRA to pay these tax, and those assets are down, well, we're not just paying 24% in tax. If your investments are down 10 or 20%, down 20 plus 24, this transaction is costing us 44% to pursue this strategy. So that's number 3. The number 4 consideration, what's the time value of money on the money that we're using to pay that tax? Right, what do I mean by that? Well, if you're 27 years old and we're taking money and moving it, paying that tax and letting that other grow Roth, right, tax-free, I've got 40 years of tax-free growth to recuperate what I have paid in tax. But what if you're 77? Do you have 40 years for the time value of money, for this strategy to pay off for you? The 5th consideration, a couple of 5-year rules or penalties that I find folks rarely hear about, okay? Anyone under 59 and a half has a 5-year clock that starts on January 1st of the year that you convert. If you take the distribution from the new Roth within a 5-year window, then a 10% early withdrawal penalty is going to apply on that principal. Okay, now principal. We're going to get to the earnings here shortly, but this is just the principal. Also important to know that each Roth conversion has its own 5-year clock that starts. Okay. Now, how about the earnings? 5 years must have passed since the Roth IRA account is established. So even if you have multiple Roths opened in different years, this 5-year clock starts on January 1 of the year that you opened your first Roth IRA, so whether by a contribution or a conversion, right? So something to pay attention to here. In addition, you've got to be 59 and a half to avoid that 10% early withdrawal penalty. Okay, so does this strategy fit for everybody? No. Now, that doesn't mean we just dismiss it out of hand. It's definitely something to talk about. Again, I'm not a CPA giving tax advice. I'd suggest you mention this to your CPA, your tax prepper. And of course, I'm happy to discuss it with you as well. It does fit for some folks, okay? Roth conversions. That's it for this time. We'll talk to you again. Have a great spring break. Weather's been gorgeous. We'll talk to you in April.